In this episode, I'm going to be giving you 2 short, quick tips that you can implement to repay your mortgage loan quicker. Welcome to the Property Corner with myself, Rowan Alexander. I've got a favor to ask of you. 3 out of every 4 people that watch this channel are not subscribed to the channel. It's a 73% of all watchers haven't subscribed. Subscribers are what builds our channel and allows us to do more things and create better content. So if you're finding value from these videos and you're enjoying them, please take the time to consider subscribing and maybe sharing this channel with people that you feel could extract some value out of it too. Subscribers really keep us motivated and allow us to progress this channel. So please take the time to subscribe. Thank you if you have already subscribed, and you are the backbone of this channel. Thank you. Repaying your bond quicker is the dream of every property owner. So how can you do this? What are some easy tips that you can implement to actually get to the point of sort of paying off that mortgage loan quicker? Bonds are typically 20 or 25 or 30-year loan terms. So if we can reduce that period of repayment, this can have a massive effect. So some practical tips about how you can do that over and above the, let's call it the sort of commonly known things like dumping extra cash into your bond when you have, putting away some of your savings to capitalize your bond, or, making your sort of payments when you get your bonuses, lump sum payments. I think those things are pretty self-explanatory. The 2 things that I want to share with you are more practical tips about how you can go about managing your existing sort of funds that could result in you paying that loan off quicker. As you know, making this sort of content isn't easy. We wouldn't be able to do it without the support of our local partners and sponsors. This episode is sponsored by Mortgage for You, a mortgage origination business based in Cape Town that does mortgage bonds right across South Africa. Mortgage for You has been integral in the growth of our business. They've helped us with all the expats from abroad looking to finance property in South Africa, and also assisted our local clients for the past 10 years. Their service is unrivaled. Mortgage for You can assist you with a pre-qualification and also the formal application to the banks. It's always good to get involved with a mortgage originator very early on in the process so they can understand your financial position and make recommendations prior to lodging an application for mortgage finance. Hop over to www.mo4u.co.za to check out their website. You'll find different cost calculators there that assist you in calculating your affordability, bond repayments, transfer costs, and there's also the opportunity to reach out to Esme LaRue, who's the head of that business, that will assist you personally with all your mortgage needs. So thank you to Mortgage for You for supporting our channel and for sponsoring this episode. The first one that you can do is, because we are entering into a downward interest rate cycle, if you look at your repayments in September 2024, when the interest rate was at the peak of 11.75%, what you'll do is, I've used the Uber home loan calculator to show on a 2 million rand bond over 20 years at an interest rate of 11.75, your monthly repayments would have peaked at 21,674 rand per month. Fast forwarding to February 2025, when we're in the position that the prime lending rate has reduced to 11%, you'll see that the installment has reduced to 20,644. The difference between those 2 payments is 1,030 rand. So if we then look at this extra payment calculator and we go and show and try and see what the effect would be of making that additional payment, I've taken the same 2 million rand bond over the same period at the current interest rate, but I've added a recurring monthly payment of 1,030 rand over and above your new installment. So effectively what we're doing is we're saying, if you manage to make your payments in September 2024, continue to make that equivalent payment by paying an extra 1,030 rand every month. You'll find that that loan term is reduced to 17.08 years. So it's nearly 3 years that you've managed to knock off your mortgage bond in 3 years worth of payments, and the total loan repayments that you will not then have to make, that saving equates to nearly 513,000 rand. That's massive. It's underestimated the sort of incremental small payments that you can make monthly. And this is maybe we're in a period where these are one of the practical things that you could implement that can really save you a lot of money in the long run. I know this may be harder to achieve than, for some than others, but if you've managed to make those payments during the peak of the interest rate cycles, I really want to encourage you, even if you can't pay the 1,030, even if you can just contribute 500 Rand, it's still going to have a big effect on the reduction of loan terms. So use it, implement it, make those payments monthly or sort of lump sums as and when you can, but let that be a motivator for you. So if you don't have an access facility already, sort of activated on your home loan, reach out to your bank, contact them, get them to activate the access facility, because any money that you repay over and above the amount that you should have repaid in your contractual minimum payment, you will be able to access again, through that access facility. So treat your home loan like a savings account, adding just a little bit of extra money, whether it be monthly or in lump sum payments that create you having paid more than the required minimum monthly installment, can make a very big difference. By moving any excess money you have to your home loan each month, you'll be decreasing the outstanding capital balance and the interest charged thereon. If you have an access bond facility and you followed the advice that I usually give, you can treat your bond as a savings account, and by depositing any extra cash into the loan, you will have access to that again at a later point in time. By saving in a separate account while you still have debt on your primary residence, remember that any interest that you earn, if it goes beyond the allowable interest, tax-free interest, you will be taxed on that income while you are facing the expense on your home loan. So any additional payments you make into your home loan will result in you paying less interest. And remember, you're servicing that interest cost after you've already paid tax on your income. So it's a post-tax expense, whereas the saving is a pre-tax saving. It's expense that you won't be incurring, that you won't need to service out of your after-tax income. So those two tips, while they may sound simple, can have a dramatic effect. I promise you, the moment you start treating your mortgage loan as a savings account and you start putting that extra money into your bond, that's going to be a huge motivator for you to continue doing it. And as you see that loan term reducing, as you see that outstanding capital balance reducing over time, it's going to be a massive motivator. I've helped so many people with these two simple tips, and it's just spiraled. They've really, it's been a big motivator for them to pay that property off quicker, whether they have 20 years remaining or only 5. I've seen the effect that this can have. So hope these two tips are useful. It's a short, little, quick instruction that you can implement today that will save you a lot of money in the long run.